Hello everyone, this is Sunko, the Korean bro. Today is 2023, August 16, and let's look at market, okay? Hmm. Coverage Digest reported record profits. What investors need to know. Okay, Kava stock. Diners are flocking to Kava in droves, boosting sales and profitability to unprecedented levels. The company has a big opportunity, and current financial results support management's decision to expand rapidly. The stock is richly valued, which may be reason for investors to wait for this red hot stock to cool down. As I write this, Kava stock is trading at a market capitalization of about $5.7 billion with $645 million in trailing 12-month revenue. That's a valuation of 8.8 times trailing sales. Hmm. Very pricey, even for a company hitting it out of the park like Kava. Palantir Technologies, Uber Technologies. In the first quarter, Kathy was CEO of Art Invest bought 6.8 million shares of Palantir for her firm's exchange traded funds. Since the end of March, the stock's risen 82%. An investor probably right to wonder if it hasn't run too far already. The inertial Palantir helps governments and business analyze data from different sources that typically don't communicate. Its almost well-known case studies involve cross-checking data from the FBI with various transportation departments to predict potential terrorist activity. In its early days, Palantir was criticized for relying too heavily on government contracts, but that has changed. Now, commercial customers are responsible for a majority of total revenue. Now, commercial customers are responsible for a majority of total revenue. Strong growth from both its commercial and government-facing operation allowed the company to post a $28 million net profit in the second quarter. The profit wasn't much, but it's also a lot better than the $179 million loss the company reported a year earlier. Demand for AI solutions is driving growth at Palantir, but the stock isn't cheap. It's currently trading for around 67 times forward-looking earnings estimate. If the market sees any sign of a slowdown in the quarters ahead, the stock's gains so far this year could all come crashing down. Uber Technologies. Hmm. Taper wasn't the only billionaire excited to buy Uber. James Simmons and Renaissance Technologies grabbed 5.8 million shares in the first quarter too. Both are likely pleased with their purchases. The stock has climbed about 60%, 40% since the end of March. I'll be surprised if Tapper and Simmons haven't added to or at least held onto their Uber shares. After years spent streamlining its business, the mobility company recently reported its first operating profit. Income from operations soared by $1 billion year over year to $326 million in the second quarter. Uber also produced an encouraging top-line results. Gross bookings grew 16% year over year in the second quarter, driven by mobility segment bookings that climbed 25% higher. Uber looks like a reasonably valued growth stock to buy now. At a recent price, it trades for around 34.5 times forward-looking earnings estimate. The said efforts to reclassify its drivers as employees instead of independent contracts could bring the stock crashing down. This June, the California Supreme Court agreed to hear a challenge to Prop 22, but still hasn't set a date to do so. It might be best to keep this stock on a watch list until we can be sure Uber won't need to ask the state of California, additional states likely to follow suit if the challenge succeeds. PayPal's revenue growth was just 7% last quarter, and that could fall further in future periods. Huh. The company recently announced the launch of a stablecoin, which could attract more crypto users onto its platform. PayPal is a cheap stock to own, but is it a risky one as well? Hmm. It's a leading company in the world of digital payments with 435 million active accounts on its platform. Last year, it processed an incredible $1.36 trillion of payment volume. But this is a business that's going to be tied with the health and overall growth of not just the US economy, but countries all around the world. And with inflation, economic concerns weighing on investors over the past year, it's not surprising that this hasn't been a hot stock to own. It's down 39% in the past 12 months. Despite the bearish outlook, however, this is still a solid, profitable business. Below, I'll look at how PayPal has been performing as of late, how it may do in the future, and whether or not it's a good growth stock for investors to consider as its current valuation. Sales are growing, but at a slower rate. In the company's most recent earnings report for the period ending June 30, PayPal's net revenue of $7.3 billion was up 7% year over year, but that's at a much slower rate than in previous quarters. It's a trend that could continue as the economy still isn't in a great shape. While consumers are busy spending right now, a reckoning could soon be coming as student loan repayments resume later this year, and household debt is now at a record $17 trillion. Dollars. A reckoning could soon be coming as student loan repayments resume later this year, and household debt is now at record $17 trillion. Dollars. That means there could be a ton in consumer spending in future periods as bills soar and pile up, and PayPal's growth rate could slide even more as that happens. Forward-looking investors are likely factoring that into their decision making because while PayPal's business is still doing relatively well and posted a profit of over $1 billion last quarter, tougher times may be on the horizon. Crypto to the rescue. Okay, one avenue that could give PayPal some more growth opportunity is crypto. Yes. This month, the fintech stock announced it is going to launch its own stablecoin, PayPal USD, which it says will be 100% backed by US dollar deposits, short term US treasuries, and similar cash equivalents. PayPal customers can use the coin to transfer money and to send purchases on the company's platform. PayPal already allows customers to transfer crypto, but this represents a deeper dive into digital currencies. And by offering its own coin, one that is backed by cash, it could attract people who may otherwise be wary of crypto given its volatility. Bringing more traffic onto its platform should be a win for PayPal. The big question is how just much business this will drum up for PayPal and whether it can lead to a significant improvement in its growth rate. I'm not optimistic that this will be a game changer for the business, as in tougher economic conditions, people may be inclined to avoid cryptos as a whole given the volatility often associated with it. But it's a growth opportunity for PayPal nonetheless, and given the stock's low valuation today, it could make it a better long-term buy. Analysts think PayPal stock can soar by 50%. Many analysts have been lowering their price targets for PayPal this month in light of concerns around the company's slowing growth and its margins also tightening up. However, given its low price, there's potential for the stock to still have some significant upside. The consensus analyst price target is just under $93, implying an upside of around 50% from where PayPal stocks closed last week. Price targets only look at where analysts think a stock will go typically over the next 12 to 18 months. Over the longer term, the upside could be even greater. Trading at only 12 times in its estimated future earnings, PayPal is a cheap stock to buy given the S&P 500's average forward price earnings multiple of more than 20 times. There's risk with PayPal, but you can't say that for any fintech stock right now given the uncertain future of the economy. But if you're prepared to buy and hold for the long term, this can be ideal time to buy shares of PayPal. According to this, the Commerce 360, over 80% of the top 1,000 retailers in the world still offer PayPal as a payment option. Although there are more companies offering digital payments, PayPal remains the leader in the industry. And while its growth rate may be sliding right now, that's not a pattern I would expect to see continue for the long term. PayPal, PayPal, PayPal. Hmm. Okay, PayPal finally gets a new CEO. Here's what investors need to know. PayPal is hiring Alex Chris, an executive focused on small business while working for Intuit, PayPal's on-branded checkout services that have performed well in recent years. The company could see Chris as a leader who can help take its merchant services to the next level. Could PayPal be doubling down on this under-the-radar product offering? Over the past 12 months, shares of PayPal holdings have plunged almost 40%, whereas the S&P 500 is up about 4%. The financial technology pioneer has missed out on broad market rebound because investors are understandably apprehensive. Longtime CEO Dean Schman is set to retire. The future of PayPal lies with some unknown successor. That its successor was unknown until now. On Monday, PayPal named Intuit's Alex Chris as its new president and CEO. Here's what investors need to know. Chris is joining PayPal after 19 years at Intuit, a global fintech company focusing on tax preparation software, small business software, and more. The business segment Chris led for the past 4 years, the small business and self-employed group, accounting for roughly one-third of Intuit's total revenue in its most recent quarter. PayPal's press release points out that the small business and self-employed segment grew revenue at a 23% compound annual growth rate under the Chris leadership. This is an encouraging number in considering PayPal's own growth rate has fallen well below that threshold in recent years, as the chart below shows. Some of Intuit's growth needs to be taken with a grain of salt. In November 2021, the company completed a $12 billion acquisition of MailChimp, which contributed to growth in the business segment overseen by Chris. Therefore, not all of the growth was organic. Chris deserves credit for successes. Intuit, nevertheless, his segment of the business often delivered the highest growth for Intuit. PayPal's board of directors hopes Chris' leadership and vision can reignite growth for PayPal's stagnating business, ultimately leading to better days for PayPal stock. Is PayPal tipping its hand with this hire? With around 400 million active consumer accounts as of the March quarter, PayPal is known best for its consumer-facing fintech products. However, many people don't realize that the company has a strong and growing bundle of enterprise services as well. There's a good reason that many people are unaware of PayPal's enterprise products for online merchants. While businesses can use PayPal's branded checkout services, many opt to use its unbranded checkout services. In other words, you could have purchased something online using PayPal's technology without even knowing it. Unbranded checkout services for PayPal are powered by Braintree, a company acquired $800 million a decade ago. And Braintree has been one of the better parts of PayPal's business in recent years. In fact, PayPal's transactions per active account reached a record 51.4 in the second quarter. Management says this record result was primarily achieved thanks to financial results from Braintree. Given that Braintree adoption is going so well, it makes sense for PayPal to double down on this part of the business. And this might be the exact reason it hired Chris away from Intuit. After all, at Intuit, Chris focused on small businesses, which is the same clientele that Braintree is targeting. Since Chris has only just been named PayPal's new CEO, investors still need to wait for him to share a more comprehensive long-term vision for the company. To be clear, there are still plenty of unanswered questions regarding the future of PayPal. They said it does appear that PayPal is looking to lean into what's already working well, and that could be the winning strategy that finally turns its slumping stock price around. Okay. Amazon DraftKings. Last but not least, at ODB, that could help set you up for an early retirement. You likely know the company is named behind namesake PDF tools, computer graphics software. Photoshop is still owned and updated both in fact. Adobe is so much more than just Photoshop and Acrobat these days, though it's a soup to nuts solutions provider for computer graphics professionals and enterprises alike. The first of these platforms is the digital media suite called Experience Cloud. Hmm. Three no-brainer stash buy with $1,000 right now. Mastercard, your quarter, General Motors. Software is the next big AI buying opportunity, and these four stocks are set to crush the market. Tesla, Microsoft, Amazon, C3.AI. Okay. I want to be very clear. C3.AI is the riskiest play of this bunch. Its stock has soared 197% this year, crushing even Nvidia, but still down 79% from its all-time high. The company is worth just $3.8 billion and it's still in the process of scaling its business, which comes with challenges, but it's a true AI software play that could deliver monster returns for investors in the long run. Has a portfolio of more than 40 ready-made and customizable AI applications, which it sells to its 287 business customers. The applications do everything from detecting fraud for banks to predicting equipment failures. For some of the world's largest oil and gas companies, C3.ai technology is so good that leading cloud providers like Microsoft Azure, Amazon Web Services also offer it to their customers. In fact, a business developing AI software using C3.ai on AWS can complete the project 26 times faster than just AWS alone. It's because C3.ai reduces the amount of written code required by 99%, which is exactly the type of productivity boost Kathy Wood and ARK Invest reference in their future value predictions for AI. But C3.ai has struggled to grow recently because it's currently in the middle of a transition from a subscription based revenue model to a consumption based one. Subscription agreements uh, take time to negotiate, which means onboarding customers is a slow process. Under a consumption model, businesses can simply come and go as they please while only paying for what they use, which should pave the way for faster customer growth. C3.ai's revenue growth has stalled while its customers convert to the new pricing structure, but from fiscal 2024 onward, the company expects its revenue will return to annual growth of 20% as consumption scales. If that happens, it should pave the way for a market-beating upside to C3.ai's stock, but investors should always expect volatility in a company this small, especially when it operates in a new industry like AI. Okay, they eat a dog, they eat a dog, they eat a dog, they eat a dog. quarter second earnings beat Wall Street expectation, but the company also lowered its revenue guidance for the full year. Data though stocks still look cheap related to its industry peers. Anyway, okay, this is it for today, and I'm gonna see you tomorrow. Okay, bye bye.